Good morning everyone and welcome to our first webinar of 2021. I'm not going to start off today with using all the words and descriptors to describe 2020 like I'm sure you're very tired of seeing in the media already. All that I'm going to do is I would like to thank you for your ongoing support throughout the year and going into 2021. We very much appreciate that. I'm sure it has been a very difficult year for all of our clients, both professionally and personally. I'm proud to be part of the team at Prudential who stuck to their guns during the year, firstly making sure we can work from home and focus on delivering to you what you expect of us to do, while at the same time homeschooling your kids and doing all of those things that I'm very sure you know I'm talking about. During this year, our investment team has stuck to their guns, consistently applying our valuation-based investment process and making sure we position our funds to best benefit our clients. I would also like to thank you for your ongoing support of these webinars and your ongoing demand for more of these. So today we'll start off with the first one focusing on South African equities, and we have Hamilton van Breda and Chris Wood to take you through the conversation today. All of you would know Hamilton. He's our head of retail sales, and he'll pose the questions that all of you sent through to us during the registration process, and he'll pose that questions to Chris Wood. As you know, Chris Wood is a senior portfolio manager here at Prudential and portfolio manager of the Prudential Equity Fund. They'll use that fund as basis for the discussion. Of course, it's always better to show application of our ideas in practice and how we put that at work into the fund. I'm very privileged to work with such a great team of investment professionals, and especially during years that we all think is very difficult, to watch these guys and see them and see what they do at work, effectively applying our process and making sure we lean into the cheaper assets and give our clients the right exposures in the right quantities. During 2020, we brought you a whole series of webinars, starting right in the midst of the crisis at the end of March 2020, with our first webinar where we interviewed Mark Beckenstrater. Also throughout the year, as the crisis developed, we brought you more of these webinars and gave you our views as the year unfolded. So I thought it might be a good idea to start this webinar with a brief look back at some of the most salient points we made during these webinars, and I think it will be a good basis for the discussion that we start with you today. Straight after the short video clip, we'll go to Hamilton and Chris, who lead the discussion for you today. Thank you very much for your ongoing support and for your time that you spent with us today.
Don't panic. What you're observing in markets over the last couple of weeks is not fundamental. It is absolutely liquidity driven by people who have leverage, had no business being in these markets in the first place, and are incapable of holding the assets. They are going to transfer large amounts of wealth to what we call hard money investors, people who have real money who can hold things for 5 years instead of talking about holding things for 5 years.
You know, often we hear this statement that the future's uncertain. I would just like to remind everyone that it's always uncertain and that there are always going to be unknowns. I don't know when earnings for the companies discussed today, revert back to levels seen last year.
In our view, it's a huge call to say, let's move into cash and let's wait and see. You're suggesting that you're going to know when the asset recovery is going to come. You're selling assets that are at some of the cheapest valuations we've seen in decades or even longer periods than that.
It's very dangerous to invest on the basis of a catalyst. What's going to change this, and I'm going to see it, and then I'm going to invest. My sense is that lots of people who talk about catalysts and effectively they don't want to do the very, very hard thing, which is to step into the risky assets after they've done badly and after you've had a bad experience. So you sit in cash and then you use the catalysts as an excuse to not buy anything because you actually don't want to buy anything. It's not really about, I'm going to sit in cash until I see a catalyst and then I'm going to put it to work. It's worse than that. It's just a behavioral trait that you actually don't want to have to live with the volatility that comes from doing the exceptionally hard things.
And if you look back over South Africa's history, we haven't really traded this cheaply in probably nearly 40, 50 years. You probably shouldn't be selling equity here. You should be buying more equity if you've got cash.
I hope we've demonstrated is that, you know, the SA market valuations today, in our opinion, are discounting a lot of bad news, and that it's that willingness to back the valuation signal and the odds of you know, these more attractive returns on a prospective basis.
Be greedy when others are fearful, and fearful when others are greedy. Is it time to be greedy right now?
So the world is now the most fearful it's ever been in sort of measured history. It's more fearful than it was in the 2008 financial crisis. And I find that quite surprising, because I think this crisis is easier to understand the cause, what's happening, what the economic damage is, versus in global financial crisis, we just didn't actually know if anybody was going to pay us back. So you have absolute fear in markets, and there's opportunity in absolute fear. You can cause massive damage to your own wealth here by panicking and selling all your equities or all your bonds and running to cash and saying, I want to go and sit in US dollar cash and I'm going to wait for all the problems to go away and then I'm going to reinvest it. Well, I would suggest that at the point you try to reinvest it, things might be to 20 to 30 to 40% higher than they are today.
Crises, in our view, you know, and it applies to other asset classes too, but they present opportunities, and it's you know, it's this opportunity to buy good companies at great prices that gives us confidence on our ability to deliver better returns to the investors over the next 5 years.
Good morning, ladies and gentlemen, and Peter, thank you very much for that lovely intro. So, having watched this clip, I've made some notes, just some of the key takeouts. A crisis like this has presented opportunities for investors. Market was the most fearful it has ever been since March 2020. Market was discounting lots of bad news. And in fact, it even made me think about a quote, Chris, that you said a year ago. You make the most money in a bear market, you just don't realize it at the time. So clearly it's about staying the course and leave the stock picking to us. So if you look at that, it kind of the big question is, was this the real opportunity we thought it was, Chris?
Yes, thanks, Hammy. It was indeed a fantastic opportunity to buy SA assets. And you know, it's very pleasing to be able to report back to our clients and the audience today just how good an opportunity it was. As one can see, the Prudential Equity Fund has managed to deliver almost 24% return over the period from, you know, pre the crisis last year, and that's despite the significant drawdown that we were talking about this time last year in our previous webinar. So having, you know, lost a third of its value, we can see here that, you know, we've not only outperformed the fund's benchmark by, you know, what I think is a very healthy margin, but we've also beaten a large number of our peer group.
Well, I would call it more than a healthy margin. I mean, you've outperformed the peer group or that general equity sector by 13%. And that's certainly over a 1 year period. What about over a shorter period, say from the bottom?
No, that's a good question, Hamilton, because I think I think the audience underestimates just what an opportunity this was. And one can see here that if you had taken our advice and put cash to work in the midst of that crisis, from the low in sort of late March, the Prudential Equity Fund has managed to deliver an 84% return. So that, you know, translates into the 24% over the 12 months, but it's a significantly better return when one simply considers had one, you know, instead of this kind of flight to safe haven or sit on cash waiting for a catalyst, we took our own advice, and we were very active in exploiting the opportunities available to us.
I mean, that's really a massive return. Well done, Chris. If no one says it at the office, I'm telling you now, it's a fantastic return. I mean, to outperform the benchmark over the shorter term, with more than 20%, and over a year, 10% is really good. Fantastic. I'm pleased I put my own money in. So, I mean, this fund has the ability to tactical asset allocation between local and offshore. So, I mean, I think it certainly plays to one of Prudential's key strengths, and you have the opportunity in the fund to hold a maximum of 30%. Where are you right now, and what have you done sort of during that period?
Yeah, so Hamilton, before we get to where we are, and yes, you are correct, the fund does have a portion of its assets held offshore. I think it's worth just reflecting on the chart that prompted the discussion last year and the decision to move money from offshore back to SA. And that's this price to book series. And as we heard in the video clip earlier from some of my colleagues, we referred to this as a 1 in 40-year event where South African equities were trading at almost a price to book of 1. And as can be seen in the history of the market, that is literally the cheapest entry point we've had available to us. But what's more telling on the relative to the rest of the world, which also did in fact fall in March and has continued to perform very well post the crisis, there was this significant valuation differential, and it's that we chose to take advantage of. And so going into the crisis, the fund had almost utilized 25% of its maximum 30% allowance that was held primarily in the Prudential Global Equity Fund. And over the course of this past 10 months, that has been reduced to where we stand today at 15%. Now, to put that in perspective, this was done actively through a series of selling of the offshore and repatriating the funds. But in addition, about 20% of that reduction, so of the 10, 2% is attributed to the strengthening of the currency. Because I should just add that the rand in the period March-April, we saw the rand also significantly weaken, hitting a peak of 19 to the dollar, and that too was a signal for us to essentially buy cheap rands in addition to the valuations available in the domestic market.
So I suppose we have a bit of a benefit of hindsight. I mean, did that trade really work?
Yeah, well, I'm pleased, as we saw in terms of the fund's ability to outperform that peer group, it was certainly, we have generated alpha not only from the money put to work in the South African equity market, but it's pleasing that the offshore piece of the equity fund has also beaten the all-country world index. And so there was an element of alpha generated in both pots or both portions of the fund. And it definitely worked.
So you sold some offshore equity, you bought local equity. So what did you do with that? I mean, where did you invest that?
Look, there were a number of trades, and to be honest, we were spoiled for choice. There was a competition for ideas among the team, and yeah, I think we can, the single biggest use of the proceeds that we brought back from offshore, we committed to adding to our resource exposure in the portfolio. This in part was due to the very weak rand that precipitated the crisis, and that's good for our miners. Our local miners, South Africa is resource rich, and we extract commodities that are primarily in demand elsewhere and are sold in dollars. And so the largest portion of, or the single biggest decision was to add to our platinum stocks. We bought Impala Platinum that we already held and doubled the active position. But we also switched Northam has a BE deal, and we held some Zambezi prefs that we switched into the equity, the Northam equity, as well as adding to both Anglo American and Exaro. And so it's worth, just worth highlighting two examples here on screen. The iron ore, which is all important to Exaro and Kumba and Anglo American. Iron ore prices at record highs. And then on the other commodity I'm using as an example is rhodium, which is one of the three primary metals that our platinum sector extract. And we can see that tremendous rally that has taken place, and that when one overlays that with a weak rand, it has underpinned the earnings and improved profitability of our JSE listed miners. And that has proven very beneficial to the fund.
So, one can see that has worked, but if you look at the iron ore price, you look at the rhodium price, you say they look at extreme levels, and makes me think of a question that we got prior to the webinar. When we sent out the invites, we asked the audience to send in some questions, and one of the questions was, do you feel that we're heading into a commodity super cycle, or is it more likely that the current rally in commodity prices is really due to a temporary recovery?
Yeah, so these two charts do illustrate the fact that these prices are very elevated, and most apparent in that rhodium chart. This was a metal that 3 years ago was trading less than $2,000 an ounce, and is now at approaching $25,000. There's different drivers. So the iron ore has been very much driven by Chinese stimulus in trying to restart their economy through the course of the pandemic. That leads to increased steel consumption, and this is a primary sort of ingredient into steel making. The rhodium, on the other hand, as well as palladium, were deficit markets prior to the pandemic, but as a result of impacts to supply through the course of the lockdown, we've seen that situation exacerbate, and these metals get used primarily in the by auto manufacturers in auto catalysts. So it's used to ensure emissions compliance with the prevailing regulations, and those continue to tighten. So there is no doubt that there's some very favorable tailwinds at the moment in the commodity sector. We are a little bit circumspect in that these prices do strike us as being uncomfortably high and elevated, and well above sort of the prevailing cost of production. So we're seeing record profitability, and it is a key question as to how long these prices persist and the sustainability of the very high prices.
So what about some of the domestic stocks? If you look at some of the domestic retailers like Pick n Pay did incredibly well. I think everybody was hoarding foods. You'll recall, there was a lot of jokes and WhatsApps going around. You couldn't even buy a roll of toilet paper. What about some of the other retailers? Some of them really didn't fare well at all. Were you quite defensively positioned?
Yeah, so going into the crisis, we had no exposure to our South African apparel retailers. And in fact, the only retail exposure held in the portfolio prior to March was a position in Pick n Pay and Woolworths. And yes, we were quite defensively positioned. But that was another one of the key trades for us in the midst of the crisis. We observed these very dramatic differences in price action, with lockdown having imposed a suspension of trade for all of the clothing retailers in South Africa. Malls were shut, and people were instructed to stay at home. Whereas our food retailers, as you point out, they were struggling to keep up with demand as people were hoarding food and they were deemed essential services, and they managed to continue trading. And so what that manifested in was this huge disparate, relative price performance that prompted us to actually sell all of our food retail exposure and to actually step up and buy, in this case, Foschini and Truworths. But one can see on the, just in terms of that share price, Foschini in the space of a very short period of time had lost half its value and has subsequently recovered almost 70% off the low, whereas Pick n Pay, from the point at which we sold, is actually 10% lower. So again, this is an example of having, exploited the valuation signal that was made, that was available, and actually doing the contrarian thing of selling defensive and buying cyclical.
Very much what Ross said. So if I go back a year, and I think it was you and I did the very, very first webinar, you spoke about a couple of stocks, and I know that you quite liked Bitcorp, and you highlighted it as an opportunity or potential opportunity. I mean, did that really work for us?
So Bitcorp was a stock that we used as an example, one of 4 stocks. And Bitcorp, for those that don't know, is a food services company supplying the hospitality, hotel, restaurants. It's not just a South African company. It actually operates globally, Australia, Asia, UK. And it was a company that we know well, but had felt that was, very highly rated. It's a very high quality business, but we were a bit uncomfortable about the price prior to March of last year. But Bitcorp lost half its value. Fell from sort of 300 rand to 200 rand. And created this buying opportunity. As indicated, we managed to step up and essentially another of these defensive to cyclical trades. We sold a matching amount of British American tobacco in order to fund the purchase of Bitcorp, and basically went from an underweight position to an overweight position in the space of 2 weeks. And having bought it at 200 rand, we then subsequently saw this very rapid recovery in price as people came to appreciate that the balance sheet strength, and that some of the trading, the lockdown wasn't permanent, and that Bitcorp would continue to be able to generate some profit, and we saw that share price recover 40% in less than 4 months. And typically we make investments with a 3 to 5 year time horizon, and we had every intention of buying Bitcorp and owning it as a high quality business. But I think what we were active in buying it, and then as I said earlier, there was this competition for ideas. We were almost spoiled for choice as portfolio managers, and so we actually took the decision to sell out of Bitcorp in August, and actually reverse the same trade that we'd put on in March.
Well, you made 40%, so absolutely. So if I look at some of the portfolio, you sold some defensive stocks, you bought some cyclical stocks, and also in an environment where I think many were running for the hills and seeking some protection in their portfolios. And I think this is perhaps an opportune time to address a common misconception. And I say it again, it's a common misconception, and I think it's for investors and advisors that simply don't understand it.
You're being particularly polite.
I am being polite, Chris, and I'm looking at this misconception of Prudential being a benchmark hugger. I would like you to address this misconception.
Look, it causes me endless frustration because we have to continually defend our philosophy and approach to how we go about constructing portfolios. I think the easy answer is, if one refers back to the performance that we showed at the beginning of the presentation today, I'm doing a pretty poor job of hugging that benchmark, because not only have I beaten a large portion of the peer group, but we have beaten the fund's benchmark
Substantially,
by a significant margin. But this, just to put it in perspective, in the months of March and April of last year, the Prudential Equity Fund turned over almost 15% of its fund in exploiting the opportunities that were available to us. So I do think we've demonstrated a willingness to be active. Of the universe of stocks, we estimate there's approximately 160 investable ideas for us to put money to work. The Prudential Equity Fund typically holds around 35 of those ideas. And what we're showing in this chart, which is a bit busy, is the dots represent the fund's position relative to the red, which is the index weight of the individual names. So when the dot is in the green, we're in an overweight position. When the dot sits in the yellow, we're underweight. But just to draw attention to the number of dots that are actually sort of sitting there along the horizontal axis. And those are stocks to which we have no exposure at all.
123.
And so to quantify that, the active share, which is a measure of how active the fund is relative to its benchmark, it's currently around 50%. And during the course of last year, it peaked at 52%, meaning that the fund is more than half of the fund is different to that of the benchmark that we're seeking to beat. I don't think that qualifies as benchmark hugging.
No, and the active share or the activeness is also translated into very good alpha. So clearly you were incredibly active during this pandemic. I mean, there's no doubt about it. But surely there must also be some contributors that was totally unaffected by this pandemic. Maybe you can just give us an example of a stock.
100%, Hamilton. I mean, we brought a portfolio, at all times the fund is, fully invested. It's an equity fund and has very low cash on average. And so there were a number of ideas that were embedded in the portfolio that weren't trades that we exploited as a consequence of the pandemic. What happens to actually, in this most recent 12-month performance, what happens to be one of the top 5 contributors is a little-known stock called Altron that we've owned for in excess of 5 years. It's been sitting in the fund. And we bought our stake in Altron when the market cap of the group was only 2.5 billion back in 2016. And what I think the market underappreciated within Altron was an offshore business, an IT business plying its trade in the UK called Bytes. And then admittedly with the help of some activist shareholders and bringing in new management, Altron, over the course of the past 18 months, took a decision to pursue a listing and an unbundling of Bytes. And what this chart tries to illustrate is that this company always sat inside Altron, which is the market cap shaded red. But on listing, we can see that the market is, a new set of investors listed. Bytes is listed both in the UK and South Africa. Now it has 20 billion rand attributed to it, and we still have in the portfolio the residual of Altron that has a market cap of 5 billion rand. And so this was a significant unlock of value and a key contributor. And sometimes, it goes to show that it requires a little bit of patience in order for you to realize the full extent of your investment case.
So you've sold this stock now out of the equity fund.
Correct. So we still retain Altron, so we still have the residual holding of Altron, but as part of the IPO process, we tendered a portion of our Bytes shares, and post-listing of Bytes, we subsequently have sold all of our remaining shares. So we have no exposure to the Bytes, so we've crystallized the value there, but we do still retain the Altron shares.
Orphan, do you know the contribution or percentage contribution that made to the portfolio?
So of the almost 10% alpha that the fund has achieved over the last 12 months, almost a full 2% of the 10% was attributed to the Altron position.
So if you look at where the market is today, I mean, it feels like it's an all-time high. I mean, what does that really say about the prospective return for an equity investors? And I suppose the audience listening right now will say, have we missed the boat? I mean, give us your view on this.
Yeah, that's a natural response after the market, as I've shown you from the low. The fund has done 84%. We've had this very strong recovery. But, we did show the price to book series earlier, and it's still for us is in attractive territory in that it's trading still below, about 15% below its long run median rating on a price to book basis. We look at the market through various lenses and screens of, to try and identify the value opportunities. The other measure that, is the forward PE, for example. And currently, if one uses the CAP Swix index, it's on a forward PE of around, between 10 and 11 times. But if one were to look at that same index, excluding Naspers, which is a highly rated stock, the PE on the remainder of the market is trading at sort of 9 times. And that, against its own history, again, for us, is attractive. It's an attractive entry. And so this chart we're showing on screen now is actually looking at, if we rank all the stocks available to us, excluding the real estate, which are very high yielding or high dividend yield stocks, we rank all of the stocks and rank them on their forward dividend yield. And if we look at the differential between the average of the high yielding portion of that ranking against the average of the low yielding, this is the spread. And so while that you can see on this chart, the same signal, very high yield, an additional pickup of yield was on offer in March of almost 5 percentage points to own the cheaper portion of the market. Despite the strong rally in equity markets over this past year, we're still seeing this signal that there are lots of opportunity in terms of if one is prepared to back dividend yield as a measure of valuation or of value. And it should come as no surprise that our SA banks are sitting in that cheap basket, offering very, very high prospective yield. And yes, there was a lot of concern during the course of this past year that the banks suspended their dividends, but we are very confident, and we've seen just this week an announcement from the regulator allowing the banks to reinstate dividends going forward.
I'm pleased you showed that slide because I would think that the audience would want to know a little bit more about the sustainability of those dividends, but I think you've addressed it anyway. So, Chris, you are a true alpha generator, and I really like to call you that. Maybe you'd like to share with us some of your best ideas.
No, I think we've spent today looking back at what did we say last year, what did we do, what contributed to the very strong recent performance. But I think it is one wants to now know how we're positioned for this year ahead. And so I've just chosen to pull out, these are the top 12 ranked by their active position, i.e. these are literally our best ideas that are embedded in the portfolio today. And for me it was important to cluster them sort of by broad sector to give you a sense that among those top ideas, we very much think about building a diversified portfolio. So we're not applying some sort of top-down view saying, yes, we want to play domestics and we're going to own, put all our eggs in one basket. But as you can see here, I've clustered it by, offshore earners or industrial rand hedges. The usual, it's no surprise, Naspers, is a key position in the portfolio. It's both large in the index, but it trades at a substantial discount to its investment in Tencent, and we continue to see the opportunity to unlock value, but we also like the underlying earnings growth that Tencent offers. But there are other names that may be less familiar. Textainer is a container company. Again, all of its earnings derived offshore, and it's worth noting that stock is up more than 40% this month alone. So that's yet to find its way into the performance numbers.
100% over a year.
Correct.
Or 6 months. 6 months.
Correct. So this is a surprising beneficiary of the lockdown, has meant that there's a shortage of containers today as the world scrambles to try and meet replenish supply chains, and they're in a sweet spot. There's some resources in the portfolio. We have, again, exposure to iron ore indirectly through Exxaro, which rather than taking it directly through either BHP or Kumba. We have platinum exposure through Northern. There's some bank exposure, our preferred banks, Absa, Investec, Standard Bank, and then some that aren't true domestic SA industrials, but MTN derives still a significant portion of profit in the domestic market. MultiChoice, is a pay TV operator, and it has a current loss-making business in the rest of Africa, and we're confident that they can turn around their African business. And then Truworths as a sort of a play on the domestic retailers. And so these for us are currently our best ideas. And they, as I said, to begin with, they straddle across a broad range of sectors.
So if you look at those 12 stocks, and I'm kind of looking at our investment process, would it be fair to say that these stocks are at least a 2% overweight position in the portfolio?
Yeah, so just to remind the audience, in our risk budget, we limit ourselves to a maximum over or underweight of 4% at an individual stock level. And so these being our best ideas, they are all, except for Truworths, which falls just slightly below your 2% threshold, so half the risk budget. The other 11 are anywhere from 2% overweight to, in the case of Naspers, a maximum 4% overweight.
So you take those 12 stocks, and what does that represent as a percentage of the entire portfolio?
So of the South African portion of the portfolio, these 12 stocks currently account for just over 50% of that allocation. So again, I think it talks to us being quite active and willing, to be, we certainly can't be accused of benchmark hugging.
I was going to say, I'm asking for a friend. You're not benchmark hugging, absolutely. Chris, I think at this stage of the webinar, perhaps if you can take us through the long-term track record of the fund, and I'm going to specifically ask you to use your analogy of game of test cricket, because I think it's one that you've actually used in the past, and I rather like it.
Yeah, I'm not actually a cricketer, but the analogy is often stuck, and I've used it a few times. So apologies to those that are familiar with it. But when looking at this long-term track record of the fund, and this is a 15-year history of us, in red, the Prudential Equity Fund in red, and the peer group average shown in the black line, I see it almost as like a run chase, and I always make the point that we're playing the long game. This is not 2020 cricket where I'm trying to hit every opportunity or every ball for 6 and in the process risk losing my wicket and having a big drawdown. Instead, we're seeking out to take easy singles and gather the easy runs, and over time those accumulate and compound into the returns that the fund has delivered. But when the bad ball does come, and that's last year March, and that bad delivery, and there's a few of them in a row, I think what we can demonstrate is that we are prepared to step up and weather some risk. And I think when the valuation's on our side, we have been able to demonstrate that we've been rewarded for taking some risk.
Well, Chris, thank you very much, and well done again. It's an exceptional return. I think what really surprises me somewhat is actually that this is a 3 billion rand fund.
Yeah, just to correct you, it's actually, as a result of those very strong performance, it's now a 3.4 billion rand fund.
3.4 billion rand
but still
fund.
It's modest. But
My contribution.
it is a significant improvement on the 2.2 billion at which it bottomed out at in March of last year. Again, just to reiterate, those clients that remained invested, and we actually did have some inflows, so some people heeded our call. We are grateful, and they have been handsomely rewarded for staying the course.
Well, Chris, thank you very much, and also to the audience. This draws our webinar to a close in terms of the formal part of the sort of presentation. And then right now we're going to try and address some of the questions from the audience. Thank you very much, and thanks again, Chris. Well done.
Thanks, Hamilton.
So I hope the audience got some value out of the formal part of the the webinar. Chris, we have had some questions prior to the webinar that, so let's just start with the first one, and I really want to start with SA banks. Both you and the audience will recall one of our previous slides where you looked at the valuation of the market and the potential opportunity, and you showed it in the form of dividend yield. Now, some of these banks are trading at very high dividend yields. I suppose the big question is it sustainable? And perhaps you can talk us through how well those banks are capitalized and perhaps make a comparison to the financial crisis.
Yeah, thanks, Hamilton. Yeah, so just this morning, for example, we've seen a trading update from Standard Bank, and it should come as no surprise that earnings year on year are in fact down, guiding toward to profits being down 40 to 50%, and that's as a consequence of impacts of lockdown resulting in having to provide for non-performing loans and having granted some relief to both corporates and consumers. But you're correct in terms of Standard Bank on a forward dividend yield is offering almost a 7% yield. And what happened last year was that the banking regulator, as a precautionary measure, issued a directive recommending that the banks withhold dividends or suspend payment of dividends. And this is, what's important about this trading update of Standard Banks is that the bank itself is still profitable. So yes, the profits are down, but it hasn't incurred losses. And so, they were trading, deep discounts. But we've not only have we managed to hold on to all of the earnings that we generated in the past year, and so we saw last week the regulator announce the relaxation of that suspension of dividends. But the banks are very well capitalized, and that for us was the key message last year, is unlike the financial crisis, going into this crisis, Standard Bank was well above the regulatory requirements to hold minimum of 7%. And these banks were 12 to 15% in some cases provided. And when one takes account of, at the current ROEs, yes, they are depressed on these earnings, but it's the recovery in the earnings and the ability to, having not paid out a dividend over the course of the past year, it gives us comfort that there will be a resumption of dividends and that the 7% that we see will be received. So, this comment applies almost to all of our South African banks. They all have a much better level of capital adequacy, and have, having not paid any dividends or paid out any of the earnings over the past year, that too has meant that they've, their book value or their net asset value has actually increased year on year, and hasn't gone backwards.
Thanks, Chris. And maybe if I can just stay with some of the interest rate sensitives and perhaps look at listed property. Now, if I recall, I think we've got two listed property stocks, SA Corp and Growth Point, and probably trading at fairly attractive yields. But maybe you can just give us an outlook on sort of listed property.
Yeah, correct. So the current Prudential Equity Fund currently has exposure to Growth Point and SA Corp, as you rightly point out. We actually discussed Growth Point during one of the webinars last year. And so while there are obvious concerns facing SA real estate in terms of rising vacancies, trading, in the retail portfolio being somewhat under pressure, I see our job as analysts or fund managers looking at these different sectors. We are bottom-up stock pickers, and our primary task is to try and assess what is the market or what's being discounted by the market in the current share price. What gives us comfort with owning Growth Point is that it holds two listed assets, one in Australia and one in Europe, that currently account for more than 60% of the value at which it trades. And so the implied valuation of the SA property portfolio, which includes an asset like the waterfront, to us is trading at a very deep discount to its carrying value and a very high implied distribution yield. And it's that pessimism that is embedded in the share price today that gives us comfort to want to own it, and that we do see this kind of a return to normal or a recovery, albeit certain segments of the listed real estate, those particularly office, do have some challenges or headwinds.
So from the time that you bought it, you've collected the rental, it's gone up a little bit. You've probably, made 12, 13, I don't know, percent?
Yeah, so we bought it in the fund at around 12 Rand. I think it's now trading at just above 14 Rand. But in addition, we collected, I think, just over 1 Rand 40 in distributions in the course of the past year. It should be noted, however, that Growthpoint, similar to the Foschini Group, did raise fresh capital by way of a rights issue during the period of ownership.
Chris, you mentioned a Foschini Group. There was also a question on SA retailers, and you'll recall our earlier question or comment where you said you sold some defensive and bought some cyclicals, Foschini and Truworths being one. There was kind of a question regarding that in an environment where the SA consumer is really struggling. Your thoughts on that? Reasons for that sort of investment?
Again, the comment relates to what's in the price. What we did and what we showed in the presentation earlier was that a stock like Foschini lost over half its value in that initial sell-off in March, April, whereas the defensive food retailers managed to hold their price levels, share prices, and it to us was just that relative value signal. And I said it in the webinar last year, is that we don't know what the future holds, or in this case, we're unclear as to when earnings will revert back to levels last seen in the 2019 financial year. But we are confident that the odds on a recovery, independent of the weak consumer, that our assessment was odds are greater for a return to something closer to levels seen in 2019 than what the share price that had lost half its value was discounting.
Okay, so let's stay with that theme with a struggling consumer. You've got unemployment sitting around about 40%. I think we can try it'll be very difficult to find a successful SOE, high debt to GDP levels. So in an environment where your economy is really struggling or stuttering, and prices have gone up quite substantially, so that doesn't really make sense. I mean, why would you want to invest in SA?
Yeah, look, I mean, it's very easy to spend an entire session bashing South Africa and the lack of growth that the economy offers. Yes, we do have high unemployment. Yes, we do have a bunch of state-owned enterprises that are arguably insolvent, and poor leadership and ongoing issues around corruption. But the point that we'd like to just remind everyone is that the relationship between the stock market price indices and that of the GDP of the country there's a very low correlation, a very poor relationship, and that increasingly is because our market indices contain companies that actually have nothing to do with South Africa. An obvious candidate in the discussion is Naspers, which accounts for almost more than a quarter, depending on which market index you reference. But for all intents and purposes, Naspers has nothing to do with South Africa. It just happens to be listed here, and its roots were based in South Africa, but it derives almost its entire market cap from its investment in Tencent. So the reason there is this poor, market indices being a poor proxy for the South African economy is the fact that the companies that make up that index and the earnings, for example, have very little to do with the local economy. The other point to make is that a large driver of the returns over the course of the last 6 months have actually come from our resources sectors. And that's to do with the discussion we had earlier around the very robust commodity price environment that we're seeing. And so those continue to underpin the earnings of the miners, particularly our platinum sector at the moment. And that again is another reason why we do still see opportunity to make acceptable returns despite the very negative outlook for the SA economy.
Chris, you spoke about Naspers. There was a question before the webinar, is what would the JSE look like in terms of performance without Naspers over the last 5 years? 28% of the index, 30% somewhere.
Yeah, so if one takes into account that Naspers and Process both derive value from the same underlying portfolio of assets, if one adds Naspers and Process together, I think it accounts for currently around 28% of the shareholder weighted index, or the JSE SWIX. If one excluded Naspers from that index, so SWIX excluding Naspers and Process, that return over the 5 years would have been about 10 percentage points lower than what the SWIX index has delivered. And that's primarily, again, talking to the fact that Naspers gives you exposure to Tencent, which has delivered very strong underlying earnings growth, coupled with a weaker rand. So investors have certainly been better off as a result of the inclusion of Naspers in our market index.
Thanks, Chris. Sorry, just for the audience's sake, I think I might have left out something. I want to go back to property, and just a comment that I want to make is, the equity fund, or Chris and Yusuf that manages that fund, are stock pickers. So they have the ability to stock pick and find, really nice opportunities. But if you look at our multi-asset funds, we are still underweight listed property as an asset class. I mean, they asset allocate. So I don't want to give the audience the wrong impression. So yes, we've done very well out of the listed property stocks that we got in the portfolio, but as an asset class, we're still underweight in our multi-asset class portfolios. Chris, I then just want to go to, there was a question on Aspen Pharmacare. I mean, is this a stock worth keeping in your view? They're also involved with sort of the Johnson & Johnson vaccine.
Yeah, so Aspen is a company to which the fund is not exposed. In fact, Prudential Equity Fund currently doesn't have any direct holdings within a JSE healthcare sector. We do have an indirect exposure to Mediclinic via our shareholding in Remgro. But to answer the question on Aspen, one of our concerns has been the level of indebtedness and the fact that Aspen has had to go through a series of disposals in order to try and address its high level of debt. But what Aspen does have is it has capacity, and it has built world-class sterile manufacturing facilities both in South Africa and Europe that enables it to, and it has excess capacity at the moment, and so it is able to potentially benefit from relationships with the likes of Johnson & Johnson in the manufacture of COVID vaccines. In addition, its primary portfolio of pharmaceutical product is in the two categories of anesthetics as well as anticoagulants. We are seeing evidence that the use of anticoagulants in treating critical COVID patients in hospital having some success, and there too, Aspen stands to benefit as a market leader in that category.
Thanks, Chris. I've really got two more questions. And then I know that you're nervous, but I might just ask you one flyer. What is the impact of a delayed or uncertainty of a COVID vaccine rollout on local equities?
Look, I mean, that has been probably the biggest disappointment has been, the lack of preparedness or forward planning by our authorities relative to the rest of the world in both procurement, securing vaccines, and obviously administering vaccines to the general population. It is pleasing, obviously, to note that our frontline healthcare workers have now been vaccinated. But those delays To be honest, it's fairly limited. I think, just this week we've been reduced back down to level 1. And if anyone, has to go out, it feels like we're back to, normal in terms of general activity taking place in retail malls and operating of businesses. There are, however, certain sectors, particularly our hospitality sector, hotels and travel, that continue to be impacted. And that, I think, is where, the need for a vaccine in order to open up, particularly international tourism, remains critical.
Thanks, Chris. There was a question on Inflation Plus. I know it may not necessarily be relevant to this webinar, but I'll try and address it as quickly as possible. And that was really looking at the performance of Inflation Plus. And my response would be, thanks for noticing. It is certainly up 32% since March. Over 1 year, it is just up over 6%. So it's outperformed both inflation and cash. We just, hopefully that fund would continue to deliver, that kind of return. Yes, in the past, and it has been tough, and it certainly has struggled. But then, having said as much, the entire low equity category was a very, very difficult category. So I think going forward, we really like the way we've positioned. If you look at some of our positions, it's really starting to come through. So let's see what happens. Those investors and advisors that had faith with us and stayed the course, as Mark Beckenstrader said, by not going to cash and staying invested, those will certainly be rewarded for their investment. So, ladies and gentlemen, that really concludes our webinar. We'd really like to thank you for listening to us. If you have any further questions, please don't hesitate to get hold of us. We've got plenty of information on the websites. Our business development managers are really waiting for your call, so please get hold of them. CPD certificates will be sent to you with a link to the presentation. And yeah, we'd just really like to, Chris, thank you again very much for your time and continue with that stellar performance. I've got my own money invested, so let's see if we can't grow this 3.5 billion rand fund. So, ladies and gentlemen, thank you very much. Have a fantastic day and be safe. Thank you very much.
Thank you. Thanks.